Usually when we talk about a medical diagnosis, there's this profound expectation of precision.
Right. Yeah. Like it's an exact science.
Exactly. It
Yeah.
feels like engineering. If you fall and break your arm, you go to the hospital, they put you in front of an X-ray machine, and it produces this stark, undeniable image.
Oh, totally. The doctor just points to a jagged white line on the screen and says, well, there it is. That's a hairline fracture.
Right. It's completely binary. It's clean. But then you step into the world of investing, specifically the stock market, and suddenly it feels like that X-ray machine is, well, it's fundamentally broken.
Yeah. The contrast completely vanishes. It's just muddy water.
It looks like static. So many people look at the stock market and all they see is this chaotic casino. But, okay, let's unpack this.
Yeah.
You constantly hear people talk about playing the market, right? Like it's a game of roulette.
Right, which is a terrible way to look at it.
It really is. So today we are looking at the actual science and art of valuing the market. Welcome to today's deep dive.
It's the absolute definition of diagnostic muddy waters when you're just standing on the outside looking in. But what we are going to do today is we're going to hand over the actual diagnostic tools.
Yes, we're going to look at the X-ray machine that the professionals actually use.
Exactly. The tools to see the real bone structure of the financial markets.
And we aren't just, making these tools up. Today, we've got our hands on the actual playbook.
Oh, this is the good stuff.
It really is. We are pulling all of our insights directly from the National Institute of Securities Markets, the NISM, specifically their certification workbook for portfolio management services distributors.
Yeah, and we're zooming right in on Chapter 3, which covers investing in stocks.
Which is fascinating. I mean, this is a high-stakes world.
It is, because this is, for all intents and purposes, the training manual for professional portfolio managers. It completely cuts through the noise of, like, financial news networks and social media hype.
Right, all that noise. So we're going to explore the exact frameworks the pros use to actually understand risk, conduct fundamental economic research, calculate intrinsic value, and decipher technical analysis.
Yeah, the real mechanics behind the curtain.
So whether you are actively managing your own brokerage account, or you just want to understand what your financial advisor is actually doing behind the scenes with your retirement funds, this deep dive is going to provide a massive aha moment.
I think a lot of people are going to be surprised by how this actually works.
Definitely. You might think stock picking is just looking at squiggly lines on a chart, but by the end of this conversation, you'll understand the deep economic plumbing that determines if a stock is actually worth your hard-earned money.
And, to understand that plumbing, we really have to start at the absolute bedrock.
Right, a foundation.
Yeah, the structural difference between owning a piece of a company and just lending that company money. Because that distinction, it dictates everything about how risk and reward are allocated.
The eternal divide between equity and debt. The NISM source material lays this out really clearly, but I think it's deeper than just, stocks go up and down, bonds pay interest.
Much deeper.
Right, like when you buy debt, a corporate bond, for example, you get stable returns with significantly lower risk. You lend your money, you get fixed interest payments on a schedule, and you get your principal back when the bond matures.
It's legally enforceable predictability.
Exactly, legally enforceable. Equity, on the other hand, represents actual ownership. It offers mathematically higher historical returns, but with significantly greater volatility.
Because those returns are completely dependent on how the company actually performs in the real world.
Right. If we connect this to the bigger picture, the entire difference really boils down to an economic concept called the residual claim.
The residual claim.
Oh,
That's
no.
the magic phrase. When you buy a bond, you're a creditor. You have a contractual right to be paid back.
Right, you're on the list.
But when you buy equity, a share of stock, you are a partial owner. And as an owner, your claim on the company's assets and earnings is residual. It comes dead last.
I love thinking about this residual claim like throwing a massive, highly extravagant dinner party.
Oh, I like this analogy. Let's hear it.
Okay, so imagine you are hosting this huge gala. You hire a catering company, you book a high-end DJ, you rent out an incredible venue.
Sounds expensive.
Very. In the corporate structure, those vendors are your debt holders and your fixed expenses. The caterer has a contract, they get paid first. The DJ gets paid. The venue gets paid.
Right. They all get their guaranteed fixed amount, regardless of how the party actually goes.
Exactly. But you, as the host, the equity owner who funded the whole thing, you only get what's left over at the very end of the night.
So if the party is a total bust.
Yeah, if nobody buys tickets and it rains, you might walk away with absolutely nothing. Or worse, you're out of pocket. In a corporate bankruptcy or liquidation, The equity owner is literally the last person standing in line to get paid.
That is a brilliant way to conceptualize it. The debts, the liabilities, the employee wages, they are all settled first. That is the fundamental risk of equity.
But wait, if I'm explicitly agreeing to be the absolute last person in line to get paid if things go bankrupt.
Why would anyone logically take that deal?
Exactly. Why do equities historically outperform safer asset classes like government bonds or gold?
Well, because if that dinner party is an absolute blockbuster success, right? Like if people are lined up around the block paying double for tickets and you make a massive profit.
Oh, I see.
Yeah. You don't have to pay the caterer a single penny more than you originally agreed to. The DJ doesn't get a cut of the door.
You, the host, get to keep all the leftovers.
Every single bit of it. All the infinite upside belongs entirely to the equity holders. And that perfectly explains the dual reward structure of equity.
Because if you own the upside, you get rewarded in two ways. First, there's capital appreciation. The stock price rises over time because the market recognizes that your dinner party is becoming incredibly profitable.
And other people want to buy your host status from you.
Right. And second, there's dividend income. If the company is consistently profitable, the board of directors might decide to take a portion of those exact leftovers and distribute them directly into your bank account.
Like a steady income stream. And beyond the financial rewards, you also gain voting rights. You actually get a say in how the corporate dinner party is run in the future.
Which is pretty cool. You're a legal owner. But getting back to the risk aspect, it really requires a specific mindset, doesn't it?
Absolutely. The market is essentially an aggregation of rational actors, and rational actors demand what we call a risk premium.
A risk premium. Okay, break that down for me.
Basically, you simply wouldn't take on the agonizing uncertainty of being last in line unless you fully expected to be heavily compensated for that anxiety.
Right. Otherwise, why bother? Just put it in the bank.
Exactly. Because the potential for a total loss of capital is higher, the required rate of return must be mathematically higher to entice you. But, and this is where portfolio managers actually earn their fees, we have to understand the specific types of risk we're taking on.
Because not all risk is created equal.
Not even close.
Okay, so the NISM text categorizes risk into three distinct concentric circles. The innermost circle is company-specific risk, which the pros sometimes call idiosyncratic or unsystematic risk.
Yeah, idiosyncratic risk. This is the risk that is entirely unique to the single company you decided to buy.
Like, let's say you invest in a revolutionary electric vehicle startup.
Right. Idiosyncratic risk is the chance that their specific CEO makes a terrible strategic error. Or, their specific battery design has a catastrophic flaw leading to a massive recall.
Or their lead engineer just ups and quits.
Exactly. It's a localized disaster. It affects them, but it doesn't really affect the rest of the stock market.
Right. It's just the risk of making a bad individual bet. Then we zoom out to the next circle, sector-specific risk.
Now you are looking at forces that affect an entire industry simultaneously.
Okay, like what?
Think about a sudden, sweeping regulatory change in the healthcare sector regarding drug pricing. Or imagine a sudden, massive drop in the global price of crude oil.
Oh, right. So your specific energy company might be run perfectly, they might have the best engineers, and zero debt.
But if the whole energy sector gets fundamentally repriced by the market, your stock goes down with the rest of them.
Wow, okay. And then we reach the outermost circle, the one that keeps everyone awake at night. Market risk.
Also known as systematic risk. And the text notes this is mathematically measured by something called beta.
Let's dive into what that actually means, because market risk is just the unavoidable reality of the macroeconomic environment, right?
It is. It's the risk of the entire global or national economy tanking. If inflation suddenly spikes to double digits, or the central bank raises interest rates aggressively, or a pandemic hits.
It largely doesn't matter what sector you are in or how genius your management team is.
No, not at all. If the entire stock market is experiencing a massive sell-off, the macroeconomic tide pulls almost all boats down with it. That is systematic risk. It's built into the system itself.
And beta is how we measure a stock's vulnerability to that tide.
Exactly. Beta is a statistical measure derived from historical data. It essentially compares the volatility of a specific stock to the volatility of the overall broader market, like the S&P 500, for instance.
So how do you read the number?
A beta of exactly 1.0 means the stock moves in perfect lockstep with the market. So if the market drops 5%, the stock drops 5%.
Okay, so a beta higher than 1 means it's more volatile.
Yes. Think of a high-growth software company. It might have a beta of 1.5. If the market goes up 10%, the stock historically zooms up 15%.
But if the market drops 10%?
This stock plummets 15%. It amplifies the market risk.
Ouch.
Yeah.
Yeah.
Conversely, a consumer staples company like a business that makes toothpaste or toilet paper might have a beta of 0.5.
So it's much less volatile than the broader market, offering a smoother ride, but obviously with less upside during a boom.
Right. Exactly.
So as a listener, you really have to stop and ask yourself right now, look at your own brokerage account. Are you holding a portfolio full of beta 1.5 growth companies, just relying entirely on capital appreciation in a bull market?
And if so, are you genuinely psychologically prepared for the reality that you are last in line if a systematic shock hits the economy?
It's a sobering exercise,
Yeah.
but it really is the absolute necessary foundation for everything else we're going to discuss. Because once you deeply understand the mechanics of these risks, you can actually start building architectural strategies to manage and mitigate them.
Which naturally leads us to the antidote.
Right. Because if the system is essentially rigged to leave equity owners holding the bag during a localized crisis or a sector downturn, how do institutional money managers actually sleep at night?
I mean, they don't just put all their cash under a mattress.
Exactly. How do we protect ourselves without sacrificing the upside?
The answer lies in the mathematics of diversification. We've all heard the folksy advice to not put all your eggs in one basket, but the institutional reality of why that works is profoundly elegant.
The math behind the cliche.
Right. It all comes down to a statistical concept called correlation.
Yes, the NISM text emphasizes that diversification only mitigates risk because the returns across different sectors or asset classes often have low or negative correlation. What does that actually look like in practice?
So correlation measures how two different assets move in relation to one another over time. If you have a correlation of positive 1.0, it means two assets move in perfect lockstep. They are effectively identical twins in terms of price action.
So if you buy two stocks with a 1.0 correlation, you haven't diversified at all. You've just bought the exact same risk twice.
Precisely. You just doubled down. Now, a correlation of 0 means their price movements are completely randomly unrelated.
Okay, so what's the goal then?
The holy grail of portfolio management is finding assets with negative correlation approaching negative 1.0. This means they move in the exact opposite directions. If one goes up 10%, the other goes down 10%.
Okay, so the goal of cross-sectional diversification isn't just buying 50 random stocks. It's intentionally finding assets that don't move together.
Yes. You spread your capital across different industries, different sectors, and different geographies.
Right, so you buy a high-flying tech stock, sure, but you pair it with a boring regional utility company and maybe a multinational healthcare conglomerate.
Because if the tech sector takes a massive hit because of, say, a semiconductor shortage, people are still going to pay their monthly electric bills.
And they are still going to buy their prescription medications.
Exactly. You are using the math of correlation to intentionally engineer away that idiosyncratic, company-specific risk and that sector-specific risk.
So if you own 30 uncorrelated stocks, a sudden CEO scandal or a localized product recall at one single company isn't going to blow a hole in your retirement plan.
That's the entire point.
But wait, I have to play devil's advocate here. There are legendary investors. Peter Lynch famously called this diversification.
Ah, yes, diversification.
Yeah. If I spend months doing deep research and I find a truly amazing generational company, a company I know is going to revolutionize its industry, doesn't cross-sectional diversification just actively water down my returns?
It's a very common pushback.
Right. Like, if I take money away from my superstar stock just to buy a boring utility company for the sake of being diversified, aren't I just guaranteeing mediocrity?
It's honestly one of the most hotly debated topics in finance, and your critique is essentially accurate. Extreme concentration is how you build massive wealth, but broad diversification is how you preserve it.
Oh, that's a great distinction. Build versus preserve.
Yeah, if you put 100% of your net worth into one single stock and it goes up 1,000%, you look like a genius. But if that company discovers a massive accounting fraud and goes to 0, you are financially ruined.
So the professional portfolio manager's mandate isn't usually to gamble on finding a single lottery ticket.
Exactly. Their job is to deliver consistent, risk-adjusted compounding returns over decades. It's fundamentally about surviving to play another day. You can't let one bad beat take you off the table entirely.
And this perfectly connects to the concept of business cycles that the text details. Because economies are not static, right? They breathe.
They absolutely breathe. They go through distinct, predictable phases: expansion, peak, contraction, and recession. And crucially, different sectors of the economy are fundamentally wired to perform differently in each of those phases.
We're talking about counter-cyclical investing.
Right. During a massive economic boom and expansion, people feel wealthy. Unemployment is low. During this time, consumer discretionary stocks do incredibly well.
Think luxury fashion brands, high-end travel companies, premium automakers.
Yes. But when the cycle inevitably turns and we enter a recession, people instantly stop buying designer handbags and booking cruises.
But they absolutely do not stop buying basic groceries, paying for their water utility, or purchasing basic medical supplies.
Right. Those are known as defensive or recession-proof sectors. If your portfolio isn't diversified across these business cycle sensitivities, your aggressive growth portfolio will eventually smash into a macroeconomic wall and get decimated.
You need the boring, defensive sectors acting as ballast to keep the ship upright when the macroeconomic storm hits.
Exactly. And the text brings up a second dimension to this defense: time diversification.
The old Warren Buffett adage, right? Time in the market beats timing the market.
Yes. Equity markets are inherently volatile on a day-to-day or month-to-month basis. But if you look at a century of financial data, staying invested over multi-decade periods naturally smooths out that volatility.
The longer your time horizon, the mathematical probability of suffering a permanent loss of capital from a temporary market crash diminishes significantly.
It just drops off a cliff.
Okay, so let's synthesize where we are. We understand the residual risk. We've built our defensive shields using cross-sectional and time diversification. We have a mix of defensive stocks and growth stocks.
We're well protected.
But now comes the actual hard part. How do we pick the specific companies? There are thousands of publicly traded companies in the world. How do professional analysts even begin to sift through that noise?
This is where we transition from risk management into the actual engine room of fundamental analysis. We are talking about the EIC framework.
EIC, economy, industry, company.
Right. It's a methodology of drilling down from the massive macroeconomic picture all the way down to the micro-level corporate details.
Because fundamental analysis is essentially the pursuit of intrinsic value. It's ignoring the flashing lights of the stock ticker and the hype on social media and rigorously analyzing the underlying economic realities of a business.
It's an analytical filtration system. You start with the widest possible lens and you systematically narrow your focus.
I used to hear people compare this to buying a house. You look at the country, then the neighborhood, then the foundation. But I actually think a military campaign is a much better analogy.
Oh, let's hear the military analogy.
So the economy analysis is like evaluating the entire global terrain and the weather. If you are planning a massive land invasion, it doesn't matter how good your individual soldiers are if you are marching into a multi-year blizzard.
Right. The macroeconomic weather dictates everything.
Then you move to industry analysis. In our military analogy, this is choosing the specific battlefield or theater of war. Are we fighting in dense jungle or open desert?
Which is huge. Even in good global weather, picking an industry that is structurally hostile, where the margins are terrible and the competition is brutal, is a strategic nightmare.
Exactly. And finally, company analysis is evaluating your specific unit or platoon. Do they have the right equipment? Is the leadership competent? Do they have a tactical advantage?
That is a phenomenal way to frame it. The EIC approach. Let's look at what the text says analysts are actually measuring at each of these three stages. Let's start with the big picture, the economy.
Analysts at this stage are poring over massive data sets. They are looking at national GDP growth because a growing economy generally translates to higher aggregate corporate profits.
They are closely monitoring inflation, too. A little bit of inflation shows healthy demand, but hyperinflation completely destroys consumer purchasing power.
And it skyrockets a company's raw material costs. They track employment numbers, wage growth, shifts in government fiscal policies, global supply chain trends. But the one metric that seems to rule them all,
The absolute center of gravity,
is interest rates.
It is impossible to overstate the gravitational pull of interest rates on the entire stock market. Warren Buffett often compares interest rates to financial gravity.
Because when the central bank lowers interest rates, borrowing money becomes incredibly cheap.
Right. Companies can take out massive loans to build new factories or hire more staff, which drives immediate growth. Consumers can easily get cheap mortgages and auto loans, so they spend more.
But more subtly, when interest rates are practically zero, the returns on safe investments like government bonds become terrible.
Exactly. Institutional money managers can't meet their return targets holding bonds yielding 1%, so trillions of dollars are forced to flood into the stock market looking for a return.
which aggressively pushes stock prices up.
And when inflation gets hot and the central bank is forced to aggressively raise interest rates, that entire mechanism runs in reverse. Gravity gets turned up to 10.
Suddenly, corporate borrowing becomes prohibitively expensive, so companies halt their expansion plans. Consumers' credit card rates spike, so they stop spending.
And crucially, if a perfectly safe, risk-free government bond is suddenly yielding 5 or 6%,
Institutional investors will immediately pull their money out of risky stocks and park it in those highly attractive safe bonds.
the stock market deflates. If your macroeconomic analysis indicates a rising interest rate environment, it completely alters how you value companies.
So assuming our economic weather report looks favorable, we deploy to the specific battlefield, the industry analysis.
Right. The NISM text says we first need to identify where the industry is in its life cycle.
Is it in the introduction phase, like early-stage quantum computing, the rapid growth phase, like artificial intelligence right now, the maturity phase, like smartphones, or the decline phase, like traditional print media?
Obviously, investors hunt for growth. But then the text introduces an absolutely legendary analytical framework, Porter's 5 forces.
Yes, developed by Michael Porter at the Harvard Business School in the late 1970s.
Decades later, it remains the absolute gold standard for evaluating the competitive intensity and the ultimate profit potential of any industry. It identifies 5 specific structural pressures that determine if an industry is a gold mine or a graveyard.
Let's run a simulation through these forces. Let's use it to analyze why some industries are miserable and others print money. Force number 1, the threat of new entrants.
This asks, how easy is it for a brand new competitor to just start up and steal market share?
Okay, so if you are evaluating a basic software as a service company, 2 smart kids in a garage can write a competing application over a long weekend, spin up some cloud servers, and instantly be in business.
Right. The barriers to entry are incredibly low, which means the threat of new entrants is very high. It's highly competitive.
But if you are evaluating an aerospace defense contractor that builds nuclear submarines or commercial jetliners,
The capital required to compete is measured in the hundreds of billions of dollars, plus decades of regulatory hurdles. The threat of new entrants is essentially zero.
that makes sense. Force number 2, the threat of substitutes.
A substitute is not a direct competitor. It's an entirely different product or technology that solves the exact same problem for the consumer.
Okay, so for the traditional urban taxi medallion industry, a ride-sharing app wasn't just a better taxi, it was a lethal substitute.
Exactly. Or for the domestic airline industry, cheap high-speed rail is a substitute. If the threat of substitutes is high, a company is paralyzed. They simply cannot raise their prices to improve margins because the moment they do, the consumer just abandons them for the substitute.
Force number 3, industry rivalry.
This looks at the existing players on the board. Are the companies locked in a vicious, highly commoditized price war, constantly undercutting each other in a race to the bottom?
Or is it a polite, consolidated oligopoly, like the major credit card networks, where everyone implicitly agrees to maintain healthy, fat profit margins?
Exactly. And forces 4 and 5 are essentially the ultimate tug of war, the bargaining power of suppliers and the bargaining power of buyers.
This is where you find the structural secret sauce of profitability. Who actually holds the leverage in the value chain?
Let's take the commercial airline industry as our historical punching bag.
Mm.
Airlines have almost zero power over their suppliers. There are effectively only 2 companies on Earth that manufacture large commercial jets, Boeing and Airbus.
And there are only a handful of massive conglomerates that refine aviation fuel.
So the suppliers have all the leverage and they dictate the terms and the pricing.
And what about the buyers?
The buyers, meaning you and me sitting at home trying to book a flight, we have all the power on our end of the transaction.
Why? Because we just open a travel aggregator website, type in our destination, and sort by the cheapest price.
Right. An airline seat is largely a commodity. We have virtually zero brand loyalty if another airline is $50 cheaper.
So airlines get relentlessly squeezed by incredibly powerful, consolidated suppliers on one side and highly fragmented, hyper-price-sensitive buyers on the other. It makes it a structurally miserable industry to achieve sustained high profit margins.
Now contrast that dynamic with a high-end luxury fashion brand or a dominant tech ecosystem.
They dictate terms to their component suppliers because every manufacturer desperately needs their massive volume contracts.
And they dictate terms to the buyers because the buyer doesn't just want a phone or a bag. They want that specific logo and ecosystem, and they will pay whatever premium is demanded.
So running Porter's five forces tells you if the specific battlefield you've chosen is even worth fighting on.
Exactly.
But I have to ask a theoretical question here. Is this top-down rigid EIC approach always the definitive answer? What if there is an absolutely incredible visionary CEO running a perfectly managed company, but they happen to be in a dying industry? Shouldn't a truly great company be able to innovate and succeed anyway?
It's a great philosophical question, but the framework is utilized as a strict filtration system for a very specific reason. Let's imagine an amazing company in a declining industry, say. The absolute best, highest quality, most efficiently run manufacturer of mechanical typewriters in the late 1990s.
Okay.
They might have brilliant management, zero debt, and the best product, but they are inevitably going to struggle against the massive macroeconomic and industry tide that is shifting to personal computers.
They might survive 5 years longer than their poorly run peers, but the economic wind is constantly blasting in their face.
Institutional portfolio managers don't want to bet on a company fighting a headwind. They want to invest capital where the macroeconomic wind is inherently at the company's back.
Which perfectly brings us to the final C in our framework company analysis. We've established a favorable economic environment, we found an industry of the structural advantage via Porter's forces, and now we need to identify the absolute best unit on the field.
This is where analysts roll up their sleeves and dive deep into the forensic accounting of the financial statements. They are looking at historical revenue growth trajectories.
They are analyzing efficiency metrics like return on equity RE and return on assets ROA.
They are meticulously checking debt levels and, most importantly, actual cash flow generation. But they are also assessing vital qualitative factors like the track record of the executive management team.
And whether the company possesses a durable competitive advantage, what Warren Buffett famously calls an economic moat.
So as a listener, think about the last individual stock you bought or the one you are researching right now. Did you systematically check the macroeconomic interest rate environment first?
Did you map out the bargaining power of their suppliers and their customers? Or did you just jump straight to the company's product because you saw a cool ad for it?
The EIC framework is designed to force you to be aggressively disciplined. And that profound discipline is an absolute prerequisite for the next most mathematically rigorous step in the entire process.
Yes, we are moving beyond the qualitative. We've used EIC to find an amazing company. But the NISM text includes this brilliant foundational quote, "Price is a fact, but value is an opinion."
I love that quote.
The stock market ticker tells us the price of a stock every single second of the trading day. But how do we know we aren't wildly overpaying for this amazing company?
Because buying a great company at a terrible inflated price is mathematically a bad investment. This is the pivot point where we move from qualitative structural analysis to rigorous quantitative analysis.
We have to mathematically calculate the intrinsic value of the business.
And the premier absolute gold standard tool for that is discounted cash flow, or DCF analysis.
Here's where it gets really interesting and admittedly a little conceptually heavy, but we are going to break down the underlying logic of the math. I love explaining DCF by comparing it to the fable of buying a magical goose that lays solid golden eggs.
It is the perfect classical financial metaphor.
Right. Imagine someone comes up to you and offers to sell you this magical goose. When you are negotiating the price, you aren't paying for the biological goose itself. You don't care about its feathers or its beak.
No, you are paying for the estimated value of all the golden eggs that goose will lay over its entire expected lifetime.
But calculating that value isn't just a simple addition problem. You can't just say, well, it'll lay 10 eggs, an egg is worth $100, so the goose is $1,000.
Exactly. Because of a fundamental financial law, an egg sitting in your hand today is inherently worth more than an egg you are promised in 10 years. You have to discount the value of the future eggs.
Why? Because if I give you a golden egg today, you can immediately sell it, invest that cash, and earn compounding interest on it for 10 solid years.
If I make you wait 10 years to get the egg, you permanently lose all that potential interest. Plus, over 10 years, inflation eats away at the purchasing power of the gold.
And crucially, there is the risk that the goose might get sick and die in year 5. So the further out into the unseen future the egg is laid, the significantly less you're willing to pay for it today.
What you have just described is the essence of the time value of money, and it is the beating heart of all DCF analysis. The intrinsic value of any financial asset today is simply the sum total of all its expected future cash flows discounted back to their present value at a specific required rate of return.
And the NISM text outlines a few very specific mathematical models to calculate this, depending on what kind of eggs the specific company lays. Let's start with the dividend discount model, or DDM.
This model is typically utilized for highly mature, exceptionally stable companies. Think legacy utility providers or massive telecommunications firms, companies that regularly and predictably pay out cash dividends to their shareholders.
The DDM operates on the premise that the entire intrinsic value of a share of stock is completely captured by the present value of all the future dividends you will ever receive from holding it.
The simplest, most elegant iteration of this is called the Gordon growth model. Now, I know we promised we wouldn't just read algebraic equations, so let's explain the relationship conceptually.
Please do.
To find the true value of the stock today, you take the dividend payout you expect to receive next year. Then you divide that cash amount by the difference between your required rate of return and the company's permanent growth rate.
Let's run a hypothetical scenario to make it tangible.
Yeah.
Suppose a blue chip company is going to pay a $5 dividend next year. You, as the investor taking on equity risk, demand a 10% annual return on your money.
Okay. And based on historical data, you estimate that the company's dividend will steadily grow at 5% every single year, essentially forever.
Okay, so following the logic, you take your 10% required return, subtract the 5% growth rate, which leaves you with 5% or 0.05. You take that $5 expected dividend and divide it by 0.05. The result is $100.
Mathematically, the intrinsic value of that stock is exactly $100. If you open your brokerage app and the stock is trading at $80, the market has mispriced it. It's a bargain, you buy it. If it's trading at $120, it's overpriced, you ignore it.
That is the elegant theory. But what happens if the company doesn't pay a dividend? Many of the most valuable companies in the world, especially high-growth tech behemoths, intentionally don't pay dividends.
Right. They take all their massive profits and aggressively reinvest them back into research and development to grow the business faster.
That's where we have to abandon dividends and move to free cash flow models. The text outlines two distinct variations: free cash flow to firm, known as FCFF, and free cash flow to equity, known as FCFE. Let's start with the firm.
Free cash flow to firm, or FCFF, calculates the total unencumbered cash generated by the business operations that is theoretically available to everyone who has provided capital to the company. Both the debt holders, like the banks and bondholders, and the equity holders, the stock owners.
When you run a DCF using this metric, you are calculating the total enterprise value of the entire operation.
The text explains the mechanics of finding this number. You start with the operating profit. But profit on an income statement is an accounting fiction. We need actual cash. So you subtract the taxes you actually paid to the government.
Then you add back in non-cash accounting expenses, like depreciation of your equipment.
But then, and this is vital, you have to subtract the actual hard cash you had to spend just to keep the business alive and growing. You subtract capital expenditures or CapEx.
If you run a delivery company, you have to buy new delivery trucks when the old ones break down. That cash is gone. You can't distribute it to investors.
You also have to subtract changes in working capital. For instance, if millions of dollars of your cash are suddenly tied up in unsold inventory sitting in a warehouse, that cash isn't free to be distributed. What is left over after all that operational reality is the FCFF.
Going back to our magical goose analogy for a second. To find the free cash flow, you calculate how much gold the eggs are worth, you subtract the taxes you owe the local king, you subtract the lumber cost of building a new, bigger coop for the goose, and you subtract the cost of the daily goose feed.
I love it.
The pile of gold left sitting on the table after all operational obligations are met is the free cash flow.
It's a perfect parallel. Now, because FCFF represents the pile of gold available to both the bankers who lent you money and the equity owners, you have to discount those future cash flows using a rate that blends the cost of both types of capital.
This specific discount rate is called the weighted average cost of capital, or WACC. Think of it like mixing hot water from the debt tap and cold water from the equity tap to get a specific temperature to fill the tub.
Exactly. It's the blended average percentage rate the company effectively pays to finance its existence.
Okay, I track with that, but I'm going to push back here. As a retail stock market investor, I don't give a damn about the debt holders. I'm not a bank. I only care about the equity portion. I want to know exactly what is available to me.
Which is precisely why analysts use the second model, free cash flow to equity, or FCFE. This metric isolates the actual cash flow available exclusively to the shareholders after absolutely all the operational expenses, taxes, and all of the debt obligations, interest payments, and principal repayments have been fully settled.
Ah, it's the leftovers at the dinner party.
Exactly. It is the residual claim mathematically realized on a spreadsheet. The calculation is similar to the firm model, but it accounts for the debt. You take your net income, adjust for depreciation and capex, but then you add in net borrowing.
Think about it. If the company takes out a massive new bank loan this year, that is a massive influx of cash that is temporarily available to the equity operations.
But if they use cash to pay down an old loan, that's cash leaving the system that equity holders can't touch.
And because FCFE represents cash exclusively for the equity holders, we don't use the blended WACC to discount it. We use something called the cost of equity. The text notes this is derived from something called the Capital Asset Pricing Model, or CAPM. Can we explain how professionals actually calculate this without reciting a textbook formula?
We can, and it ties everything we've talked about together beautifully. To find your cost of equity using CAPM, you start with the baseline, the risk-free rate. This is usually the current yield on a 10-year government bond. Let's say it's 4%. You can get 4% doing absolutely nothing and taking zero risk.
Right. So to buy a risky stock, I need 4% plus a premium.
Exactly. Next, you look at the historical excess return the entire stock market provides over that risk-free bond. Let's say the broader market usually returns 6% more than government bonds. That's your market risk premium.
Okay.
Now you multiply that 6% premium by our old friend from Section 1, beta.
The volatility measure.
Yes. If your specific stock has a high beta, say 1.5, meaning it's highly volatile and risky, you multiply that 6% premium by 1.5, giving you a 9% required premium. Add that to your 4% risk-free base rate, and your cost of equity is 13%. That 13% becomes your discount rate in the DCF model.
So mechanically, if a stock is fundamentally riskier, its beta is higher. That mathematically drives up the cost of equity, which means your discount rate is higher. And if you divide your future cash flows by a significantly higher discount rate, it drastically lowers the present value of the stock.
The mathematics perfectly reflect the economic reality. Higher systemic risk demands a higher expected return, which means you must demand a lower entry price today to justify the purchase.
But let me challenge the entire premise of DCF for a second. These incredibly elegant formulas rely absolutely 100% on predicting the unknowable future.
That is the Achilles heel.
Right. What if our growth estimate in the model is just completely wrong? What if we confidently predict the company's free cash flow will grow at 8% a year for the next decade, but due to an unforeseen competitor, they only grow at 2%?
Then your intrinsic value calculation will be wildly, catastrophically inaccurate. You will calculate that the stock is a bargain, you will buy it, the cash flows won't materialize, and you will lose a fortune.
That's terrifying.
It is. This is precisely why the NISM text explicitly warns that valuation is an art as well as a science. You can build an incredibly complex 50-tab Excel spreadsheet with immaculate interconnected formulas, but if your human assumptions about future growth and profit margins are flawed, the output is functionally garbage.
It is the purest expression of the garbage in, garbage out principle.
Absolutely.
Which perfectly transitions us to the next toolkit.
Yeah.
Because DCF is incredibly rigorous, but it's clearly not the only way to value a company, especially if the company is young and doesn't have predictable cash flows yet, or if it is an incredibly asset-heavy legacy business.
Right. Sometimes you don't actually care about projecting 10 years of theoretical future cash flows. You just care about what the company physically owns right this second. This brings us to asset-based valuation.
The text calls this replacement value, which conceptually is just taking the current market value of all their assets and subtracting all their liabilities.
This methodology is primarily used for highly tangible, asset-heavy businesses. Think of massive real estate holding firms or companies dealing in physical commodities like gems and jewelry. You look at their balance sheet, you hire appraisers to adjust the historical cost of those physical assets to their current fair market value, you subtract the debts, and that final net number is your intrinsic value.
But the text notes a catastrophic flaw with using this broadly. It completely ignores future operational profits and human innovation. Think about it. If you tried to value a company like Apple based purely on the physical factories they own, the glass in their inventory, and the cash in their bank accounts, you would completely miss the hundreds of billions of dollars in intangible value generated by their sticky software ecosystem, their patents, and their massive brand loyalty.
Which is why asset-based valuation remains a highly niche tool. For the vast majority of equities, when DCF feels too reliant on fragile future assumptions, analysts turn to the most common alternative, relative valuation, which is also universally known as using multiples.
Relative valuation is basically stepping back and asking, I don't know what this is objectively worth, but how much is the collective market currently willing to pay for similar companies?
Instead of predicting a decade of cash flows, you just compare the company to its direct peers. It's exactly like pricing real estate in a residential neighborhood.
You don't calculate the raw cost of the lumber, the concrete, and the labor required to build the house. You just look at the comparable house next door that sold last week and price yours similarly.
Exactly. And the undisputed granddaddy of all relative valuation metrics is the PE ratio, price to earnings. You take the current stock price and divide it by the earnings per share.
It's a remarkably intuitive metric. It tells you exactly how much investors are willing to pay today for one single dollar of the company's annual earnings. A PE of 20 means investors are paying 20 times the company's annual profit to own the stock.
The text makes a crucial distinction between trailing PE and forward PE. Trailing uses the actual audited earnings from the past 12 months. It's historically accurate, but investing is a forward-looking game. Forward PE uses Wall Street analyst estimates for the next 12 months of earnings.
And you utilize the PE ratio by comparing it. If the specific tech company you are evaluating has a PE of 15 and the historical industry average for tech companies is 25, your company might be significantly undervalued. It's a very quick, very powerful heuristic.
Very powerful.
But I have to ask, if the PE ratio is so universally popular, why do we need this massive laundry list of other multiples outlined in the NISM text? Why would I care about anything else if I just want to know what my share of the profits is?
Because different industries have fundamentally different financial DNA. And frankly, earnings can be legally manipulated by clever accountants. You simply cannot value a massive global bank the way you value a scrappy tech startup. Let's look at the PBV ratio, price to book value.
This compares the market price to the net worth, or the book value of the equity per share.
Exactly. For a software company, PPV is utterly useless because their most valuable assets are lines of code and algorithms, which don't show up accurately on a traditional balance sheet.
Oh, that makes sense.
But for a bank, their assets are the actual loans they've issued, and their liabilities are the deposits they hold. A bank's balance sheet is highly reflective of its actual liquid value. Therefore, PBV is the premier foundational metric for the financial services sector.
Okay, what about the PS ratio? Price to sales. You divide the total market cap by the total top-line revenue. Why use gross sales instead of bottom-line earnings?
Two primary reasons. First, what if a company is a hyper-growth, early-stage startup and isn't intentionally making a profit yet? Their earnings are technically negative, which means calculating a PE ratio is mathematically meaningless, but they still have rapidly growing sales, so PS gives you a valuation anchor.
And the second reason?
As I hinted at, accountants can legally massage earnings using aggressive depreciation schedules, restructuring charges, and tax loopholes. It is significantly harder to fake top-line sales. Cash hit the register, or it didn't. Sales are a pure, cleaner number.
Next on the list is the PEG ratio, price earnings to growth. This involves taking the standard PE ratio and dividing it by the company's expected annualized earnings growth rate.
This is a brilliant, widely utilized metric because it essentially levels the playing field across different phases of the business cycle. Let me illustrate.
Please do.
A hypergrowth tech company might have a PE of 50, which looks terrifyingly expensive to a traditional value investor when compared to a mature utility company with a PE of 10. But if that tech company is actively growing its earnings at a staggering 50% a year, its PEG ratio is exactly 1, 50 divided by 50.
Okay.
Meanwhile, if the boring utility company is only growing at 5% a year, its PEG is 2, 10 divided by 5.
That's fascinating. So suddenly, the mathematically expensive tech stock is actually offering a significantly better value proposition than the cheap utility stock once you adjust for the trajectory of growth.
Exactly. The text states that a PEG ratio of exactly 1 is generally considered fair value. Less than 1 indicates the stock is undervalued relative to its growth, and greater than 1 suggests it's overvalued.
And then we wade into the heavy institutional waters with EBITDA, enterprise value to EBITDA.
Yeah, that's a mouthful.
Honestly, that sounds like corporate jargon bingo.
EBITDA. It does sound intimidating, but it's arguably the most crucial metric for mergers, acquisitions, and highly capital-intensive industries like manufacturing or telecom. It compares the total enterprise value of the firm, remember, that includes the equity and the debt, to its operating profitability before interest, taxes, depreciation, and amortization.
Wait, why strip out the debt and the interest? If I'm buying the company, don't I care about how much interest they owe the bank?
You do, but EV/EBITDA is designed to let you look purely at the operational cash engine of the business, independent of how the current management decided to finance it. It makes it capital structure neutral.
Ah, I see.
It allows an analyst to compare two massive manufacturing plants side by side, even if Plant A was funded entirely by issuing stock and Plant B was funded heavily by taking out bank loans. It strips away the financing decisions and just asks, how efficiently does this factory turn raw materials into cash?
And finally, the text emphasizes the importance of non-financial metrics, because sometimes the quarterly financial statements lag significantly behind the daily reality of the business operations.
Exactly. The financials are a rearview mirror. If you are valuing a telecom company, the leading indicator is ARPU, average revenue per user. If you are valuing a power plant, you obsess over the plant load factor. For a retail chain, you are tracking daily footfall in the stores or website traffic.
These raw operational metrics often predict the future financial realities quarters before they ever show up on an audited income statement.
They absolutely do.
Okay, take a breath. We've spent this entire deep dive looking deeply under the hood of the car. We've analyzed the macroeconomic weather systems. We've pulled apart the competitive engine using Porter's forces. We've mathematically forecasted the future fuel efficiency with rigorous DCF models, and we've compared it to other vehicles using relative valuation multiples. This entire massive undertaking is fundamental analysis.
It is the exhausting, rigorous, deeply logical pursuit of intrinsic value.
But there is a whole other incredibly popular school of thought in the financial markets, a school that essentially argues that everything we just discussed is a complete waste of time.
Yep, they really do.
They argue you don't even need to open the hood of the car. You don't need to know how the engine works or who built it or what the interest rates are. You just need to watch how fast the car is driving, look at the skid marks on the road, and see where the traffic is flowing.
Yes. We are transitioning to the final analytical methodology. We are talking about technical analysis.
So what does this actually mean in practice? The NISM text states that technical analysis operates on one massive underlying assumption, that all known information, every piece of fundamental data, every macroeconomic shift, the quality of the CEO, the global market sentiment, is already instantly and fully reflected in the current stock price.
That is their core philosophical premise. It's often linked to the efficient market hypothesis. Their argument is essentially, why spend 3 weeks building a fragile 50-page DCF model when the collective aggregated wisdom of millions of buyers, sellers, and supercomputers has already perfectly priced all that fundamental information into the stock right now?
So technical analysts, often called chartists, focus entirely on historical market data. They only look at two variables, price and volume. They firmly believe that market prices are determined solely by the raw forces of supply and demand, that prices naturally move in recognizable trends, and that those trends persist for appreciable lengths of time before reversing.
I often explain the divide this way. Fundamental analysis is studying the complex thermodynamics of the atmosphere, measuring the barometric pressure, tracking ocean currents, and running meteorological models to predict if it will rain tomorrow.
And technical analysis.
Technical analysis is simply looking out the window, seeing dense, dark clouds, noting that the wind is blowing aggressively towards your house, and grabbing an umbrella.
That is a remarkably pragmatic way to frame it. But I have to be cynical for a moment. If technical analysts don't care about the intrinsic value of the business at all, aren't they just playing a massive, self-fulfilling game of human psychology? Isn't this just astrology for finance bros?
It's a very common critique, and the honest answer is yes, it is absolutely a game of psychology. But human psychology, especially when fear and greed are involved in financial markets, is remarkably consistently repetitive.
Which is why the patterns work.
That is precisely why chart patterns actually work. The text highlights foundational tools like support and resistance levels, Let's look at the psychology behind them.
Right. A support level is a historical price point where a falling stock repeatedly stops falling and bounces back up. A resistance level is an invisible ceiling where a rising stock repeatedly struggles to break through and falls back down.
And what are those invisible lines, really? They aren't magical force fields. They are visual mathematical representations of mass human behavioral anchoring.
Okay, give me an example.
Let's take resistance. Imagine a stock hits $100, then crashes to $70. The people who bought at 100 are sitting in agony, experiencing deep loss aversion. They anchor to that $100 price. They tell themselves, if this stock ever just gets back to 100, I will sell it immediately just to break even and end this pain.
So when the stock slowly climbs back to 99, 100, a massive wave of those trapped investors suddenly execute their sell orders simultaneously.
Exactly. That sudden, massive influx of supply overwhelms the buyers, and the stock is violently pushed back down. That creates the resistance ceiling. Support works the inverse way,
It's the price point where buyers watching from the sidelines collectively feel the stock has gotten so fundamentally cheap that they eagerly step in to buy.
creating a wall of demand that physically halts the price decline.
And the text says that if a stock finally breaks through a historical support or resistance level, it implies the underlying mass psychology, the fundamental balance of supply and demand, has drastically changed. The trapped sellers are finally gone. A new trend is starting.
But, and this is the most vital caveat in technical analysis, the NISM text emphasizes that any significant price movement must be confirmed by volume. Volume is the total number of shares actively being traded. Volume acts as the ultimate lie detector test for price movements. If a stock manages to inch up and break through a major resistance ceiling, but the trading volume for that day is unusually low, it implies there isn't any real broad conviction behind the move. It's just a few retail traders pushing a thinly traded stock.
So it's likely to fail.
It is highly likely to be a false breakout and will collapse back down. But if the stock violently breaks through resistance on massive record-breaking volume, it means serious institutional money hedge funds and pension funds are aggressively entering the trade. The volume confirms the validity of the new upward trend.
The text also touches on moving averages, which mathematically smooth out the chaotic daily volatility to reveal the longer-term underlying trend. And it categorizes different types of charts like line, bar, and Japanese candlestick charts. But it seems the ultimate philosophical distinction between fundamental and technical analysis comes down to the time horizon.
That is the perfect summary. Fundamental analysis is about calculating intrinsic value and deploying long-term investing capital. You buy a mathematically mispriced asset and you patiently wait for the broader market to eventually realize its true value.
And technical analysis.
Technical analysis is entirely about capturing momentum, anticipating short-term future price movements, and trading the tape. You are simply trying to expertly surf the current wave of human sentiment.
Wow. Okay, we have covered an absolutely massive institutional amount of ground today. Let's do a quick structural recap of the journey we just took.
Sounds good.
We started by completely deconstructing the unique, somewhat terrifying, but historically highly rewarding residual risks of holding equity. You are dead last in line in a bankruptcy, but you own the infinite upside of the corporate dinner party.
We then explored how professionals actively protect themselves using the two dimensions of diversification. Mathematically spreading risk cross-sectionally using uncorrelated assets, and spreading risk across time to survive the inevitable expansions and recessions of the business cycle.
We then learned how to structurally filter the entire global economy through the EIC framework, assessing macroeconomic gravity like interest rates, evaluating the brutality of an industry using Porter's 5 forces, and analyzing the company's ultimate competitive moat.
We waded deep into the heavy, rigorous mathematics of calculating exact intrinsic value using discounted cash flow models like DDM, FCFF, and FCFE, always remembering the profound impact of the time value of money, the cost of capital, and the danger of garbage assumptions.
We looked at the relative shortcuts of valuation multiples PE, PEG, EBITDA, to see what the market is willing to pay for similar financial DNA. And finally, we look at how to read the market's collective mind, its behavioral psychology and momentum through the lens of technical analysis.
If you've absorbed this, you now essentially possess the foundational analytical toolkit of a licensed professional portfolio manager. Whether you are looking at a company's free cash flow generation, its PEG ratio relative to its tech peers, or a high-volume price breakout on a candlestick chart, you now understand the deep underlying mechanics driving that stock.
You aren't just looking at the murky, chaotic casino anymore. You are finally looking at the structural financial X-ray. But before we sign off, I want to leave you with a final, slightly provocative thought. Something that wasn't explicitly in the NISM workbook, but builds directly on the friction between everything we've discussed today.
Oh, I always look forward to these.
Think about the rapidly approaching future of this entire industry. We've spent an hour talking about how rigorous and data-heavy fundamental valuation is, and how pattern-driven technical analysis is. Today, deep learning algorithms and artificial intelligence are increasingly capable of perfectly executing both of these methodologies flawlessly.
Yeah, they really are.
An AI can read, parse, and analyze every global financial statement instantly. It can calculate a perfect, dynamically updating DCF model and simultaneously recognize a macro-technical breakout on a chart, executing a massive trade in literal milliseconds.
It is a profound tectonic shift happening in institutional finance right now.
So the overarching question is, as these financial machines get faster, smarter, and more ubiquitous, will the stock market eventually become so perfectly, ruthlessly efficient that the very concept of an undervalued stock ceases to exist entirely?
If the algorithms instantly know the exact intrinsic value of every asset on Earth, the market price will theoretically always equal the true value.
Right. So where does the human investor, armed with their human psychology, actually find their edge in a world where the machines have already read the X-ray?
That is a phenomenal existential question. It strikes at the very heart of the active versus passive management debate, and it questions the future value of human capital in the financial markets.
It's definitely something for you to mull over as you pull up your brokerage app and look at your own portfolio through this new, highly professional lens. Thank you so much for joining us on this incredibly deep dive into the mechanics of the market. Until next time, keep questioning the consensus, keep learning the math, and always keep looking for the true value beneath the daily price.